But a regional bank stock seeing a nice bounce this month. The KRE is up 19% compared with the broader bank index, which is up just 10%. Our next guest thinks M&A activity is going to be a key catalyst for the group going forward. Here for a Power Lunch exclusive is Tom Michaud. He's president and CEO of KBW, a Stifel company. He joins from the KBW Community Bank Investor Conference in New York City. Tom, welcome. Good to have you with us. We'll get to banking consolidation in a moment, I'm sure, but I want to get your hypothesis on why regional bank stocks have been as hot as they have been in the month of July. It ain't just the weather, that's number one. And number two, what would an interest rate reduction from the Fed mean both for the businesses of regional banks and for their stock prices?
Sure thing. So first of all, number one is there was a lot of bad news already priced into these stocks. And when you look at the fundamentals, for example, the most recent quarter, over 80% of banks met or exceeded earnings estimates for the quarter. Credit quality for the banking industry has been actually very benign. And with the prospect of interest rate changes maybe coming as early as this September, the backdrop for these banks fundamentally is pretty good. We also think the second quarter is going to be the low point for net interest income. So the stocks had a lot of bad news into them. The results turned out to be pretty good, and the valuation gap with the market was so historic. We think these stocks were a coiled spring ready to move, and we think that's what you see happening right now. Our view is that it's going to continue. There was a lot of talk, Tyler, that these stocks were moving because of the Trump bump after the convention. The reality is, even with the change in the Democratic nominee, these stocks are still outperforming. So it's much more than just the election. It's also fundamentals, and we think it's got longer to go.
Yeah.
These stocks still trade at a discount to historic levels.
That's a really clear explanation, Tom. How about the impact of an interest rate cut on the businesses of regional banks?
Well, so what we like is we like orderly. And it's my opinion that we're likely to get a cut in September. As long as we don't get the big swings, like the way rates came down at the beginning of the pandemic, then the way the rates went back up, that is a disorderly market that's bad for banks. Anything that's happening that's orderly is good. Also, I'll tell you another bull case for these stocks, Tyler, is that credit quality's been benign and the Fed hasn't even cut rates yet. When the Fed starts easing, that's going to take pressure off of any credit quality concerns. And I think that's all going to be a positive for the industry. I think it'll also hopefully make the yield curve not be inverted. Another point I'll make to you is that for the last 67 years, we currently have the longest inverted yield curve that we've ever had. And when that stops happening, that'll be good for the banks.
Tom, we spoke with three of the regional banks there last hour, Pennsylvania-based, Silicon Valley area, and down in Houston, Texas, and they were uniformly positive on the economy and the consumer. What does that tell you?
It tells me, I mean, we've got over 100 banks here, and the story is the same. Aside from a few banks that got off sides, the industry, by and large, credit quality is benign and actually even better than historic averages. So I think it says a soft landing for now is a reasonable outlook. And given where these stocks, bank stocks trade, I think that leaves a lot of room for the upside.
How much more consolidation? It's already happening. A couple of deals earlier this week, yesterday. What's next in the area of consolidation, and what will drive it?
So the turmoil of last year really put a pause on consolidation. There is considerable pent-up demand for consolidation. If I were to show you a chart of profitability in the industry, you would see that scale is working. So there's a lot of pressure for regional banks to come together so they can compete with the biggest banks in the nation. And I think it's good for the industry. The other thing I can say is the bank stocks after these merger announcements have been acting very well. So investors have been supporting them. I think from a policy perspective, it's good for the industry for these big banks to have more competitors. Remember, there are only 145 banks in America above $10 billion in assets. The top 25 control 66% of the deposits. So what's happening in that middle tier is really important. And I think you're going to have regional champions emerge that will be able to compete more with the bigger banks, which is good for Main Street America and the Main Street economy.
It's sort of paradoxical, isn't it? when you consolidate, you create fewer banks. And so you say, well, the fewer means less competition. But what you're saying is fewer will be bigger banks better able to compete with the super banks.
So let's talk about, JP Morgan's $4 trillion, round numbers, in assets. Two $8 billion banks that merge together create a $16 billion bank. What you'll see is a $16 billion bank can offer more products to Main Street America, where, remember, over half the jobs in America are in Main Street. Those top 25 banks have 66% of the deposits, but they do not make 66% of the middle market loans. That's why these smaller banks are falling behind, because of all the cost of regulation and technology. If they get a little bit bigger, they can be more competitive, and that's what the statistics talk about. The other thing, Tyler, is I just can't miss this moment. The unfinished business from last year is we need deposit insurance reform, because what we went through last year was, at a moment of concern or crisis, deposits go to the too big to fail banks. The government has responded with higher capital rules, but they didn't address the core issue, which is these middle market banks need a higher deposit insurance limit, and they haven't addressed that yet. That is what we talk about at this conference as a missing piece of policy reform.